Assalamualaikum and a good day for Dr. Basha and fellow friends. In this presentation, we would like to discuss about case 21, which is transfer pricing and tax implications. First of all, let us introduce ourselves. We are from Group 1. At the blue color, this is me, Muhammad Patthi. As you can see at the green color, Wong, and the red is Intan. Okay. Let's delve into captivating story of Apple, a multinational tech giant that has significantly shaped the landscape technology and consumer electronics since its establishment in 1976. The headquarters in the bustling state of California, the company has grown into a global powerhouse operating in over 50 countries. In its early years, Apple navigated the complex world of taxation, benefiting from the favorable tax rulings in 1991 and 2007. These rulings provide the company with strategic advantage, allowing it to focus on its core mission of technological advancement. However, the winds of change swept through Apple in 2015. The favorable tax arrangement that once served as a catalyst for growth underwent a transformation. Apple business model is carefully orchestrated symphony of hardware manufacturing, software integration, and strategic product distribution. The company's commitment to quality extends beyond its product, encompassing the entire user experience. To bring its innovation product to life, Apple relies on strategic partnership with contract manufacturers. One such notable partner is Foxconn, a key player in the electronic manufacturing industry. This collaboration highlights Apple's commitment to delivering cutting-edge technology through a network of reliable partners. In this presentation, we would like to explore some challenges faced by Apple Director of Finance Michael Monaghan. Sorry if I butchered the name, as he deals with potential tax issues and ethical concerns within the company, as you can see in this issue. Michael uncovers possible transfer pricing risk and tax avoidance problem, particularly in Apple's Irish subsidiaries, raising questions about the legitimacy of tax benefit received. Caught in an ethical dilemma, Michael engaged in discussion with Director of Operation Rebecca Quinn. They contemplate restructuring to address this concern and ensure a more ethical financial approach. Tension escalated with Apple's US representative Scott Trenton as ethical concerns surrounding tax practice come to the forefront. Balancing legality and ethics become a critical aspect of the discussion. Apple's corporate governance practices are identified as contributors to aggressive tax planning. This realization adds complexity to the situation, requiring careful consideration of the company's overall structure and policies. As the Director of Finance, Michael finds himself in a challenging position. While the tax practice may be legally acceptable, they raise ethical questions. Michael committed to finding resolutions that align with ethical standards, even if it means navigating legal gray areas. Alright, let us look at the ethical dilemma faced by Michael at Apple and how he can make the right decisions. Michael's ethical dilemma at Apple involves carefully consideration of legal and ethical factors, stakeholder impact, and long-term consequences. His decision will shape the future of Apple and its commitment to ethical business practice. To inform his decision, Michael should seek legal advice, consult relevant stakeholders, and involve the board of directors in the decision-making process. Alright, for the legal versus ethical, Michael must balance Apple's legal compliance with his ethical responsibility for fair business practice and adherence to regulatory standards. The decision's impact on stakeholders, including employees, shareholders, and the local economy, is crucial. Michael must weigh this consideration in finding the best solution. Finally, assessing potential long-term consequences for Apple himself and the company reputation is vital. Michael needs to make choices that align with Apple values. Next, let us look into the decision faced by Michael as he grapples with challenging situations involving potential illegal activities related to tax benefits. Option number 1, reporting to the European Commission. Michael is considering reporting the issue to the European Commission following EU state aid rules. This aligns with fair competition and ethical business practice, but could harm Apple's reputation and lead to legal problems. It's a tough decision, balancing doing what's right with potential risks. Let's say for option number 2, remaining silent. Another option is for Michael to stay quiet, avoiding immediate legal consequences for Apple. While this might protect the company in the short term, it raises ethical concerns. Remaining silent could be seen as accepting potentially unethical practice, posing long-term risks for both Apple and micro reputation. For additional challenge, Irish tax authority awareness. Adding the complexity, is unclear if the Irish tax authority knows about Apple's preferential treatment. If unaware, Michael faced a tough choice: cooperate the authority or stay silent. His concern about Apple's aggressive tax planning adds an extra layer of difficulty. In the midst of these choices, Michael is advocating for Apple to stick strictly to tax guidelines. He wants fair and ethical tax assessment, considering the legal and ethical aspect of financial policies. Whether reporting, staying silent, or advocating for ethical practice, each option has its challenges, emphasizing the complexities of making tough decisions in the business world. We will explore proactive measures that Apple, a multinational company, to address transfer pricing challenges and ensure ethical tax practice. Here are our suggestions. We'll start with reassess corporate structure, where there will be conduct a review of Apple's corporate structure, particularly subsidiaries in tax havens. Ensure alignment with legal requirements and ethical consideration. Next, operational changes. Evaluate and adjust operation to align with economic realities, moving away from a sole focus on tax consideration. Reassess function, risk, and assets within the corporate structure. Move along. Update transfer pricing policies. Establish fair and transparent transfer pricing policies based on economic assessment, not solely on employment considerations. Ensure compliance with relevant regulations. Next, engage in APAs. Consider as advanced pricing arrangement with tax authorities to establish agreed upon transfer pricing method, providing certainty and reducing dispute risk. Next, enhance corporate governance. Strengthen corporate governance, especially in financial decisions related to taxation. Consider forming a dedicated tax committee within the board of directors. Next, complying with guidelines. Stay informed about local and international tax guidelines. Complying with these standards is crucial to avoid legal issues and maintain a positive corporate image. Proceeding to ethical tax planning. Adopt a responsible approach to tax planning, balancing legal compliance with ethical considerations. Avoid aggressive tax strategies that may push legal and ethical boundaries. Additionally, for regular audits and reviews, conduct a regular internal audits and reviews of financial tax practice to proactively identify and address potential issues. Ensure ongoing compliance and prevent problematic practice. Move on to legal consultation. Seek legal advice to ensure Apple's operations and transfer pricing policy comply with relevant laws and regulations. Legal experts can guide on best practice and identify potential risks. Lastly, open dialogue with tax authorities. Foster open communication and collaboration with tax authorities. Building trust through dialogue can reduce disputes and provide clarity on complex tax matters. So, by implementing these measures, Apple can cultivate a sustainable and ethical approach to tax practice by minimizing the risk of transfer pricing issues and associated legal and also reduce risk reputational consequences. Alright, I will leave to another presenter to discuss further of this case. Thank you.
Hi, I'm Intan. So I'm gonna explain about how can he overcome the ethical dilemmas faced and what are the alternatives that he can use to convince court. So, corporate governance to address transfer pricing issue involves a combination of policy changes, transparency initiative, and ethical considerations. Here are such as approach for Michael to propose and implement these changes while addressing ethical dilemmas to convince court. So first is develop comprehensive corporate governance plan. So propose a detailed corporate governance plan specifically addressing transfer pricing issue, and it also consider establishing separate committee and task force responsible for overseeing the ensuring compliance with transfer pricing policy. Next, enhance transparency. For increased transparency is financial reporting, especially concerning intercompany transactions. Meanwhile, implement regular and detailed reporting mechanism for transfer pricing to ensure all the relevant stakeholders are informed. Third, educate and train employees. So conduct training program to educate employees, especially those involved in pricing decisions, about the importance of ethical transfer pricing practice and can promote a culture of compliance and ethical decision making throughout the organization. Fourth, review and update transfer pricing policy. Make a regular review and update transfer pricing policy to align with changes in tax regulations and business operations. Review and update policy necessary to ensure the policy are robust and compliant. And lastly is continuous monitoring and improvement. Establish mechanism for ongoing monitoring and periodic review to ensure the effectiveness of the proposed changes and be open the feedback and adjust the governance framework as needed to address emerging challenge. Okay, for by combining these elements, maker can present a comprehensive and persuasive proposal to Scott, emphasizing the ethical and financial benefit of enhancing upfell corporate governance to reduce transfer pricing risks. That's all from my part, and thank you.
Hi, my name is Wong Qi Rong. Today I'm going to talk about the question 4. Michelle is facing the risk where he could be convicted as well if the alpha is founding godly. He might lose his job due to his failures to alert the related parties. What can he propose to alpha to do next? Overall, are there any changes that can be made that are within Michelle's jurisdiction and powers of a director of finance? So Michelle, as a director of finance, is in a challenging position with a significant ethical consideration. Here are some recommendations for him to navigate this situation. First, internal review and reporting. Conduct a true internal review of upfall transfer pricing practice, ensuring compliance with both legal and ethical standard. Comply a detailed report outlining the retrospective tax assessments and the potential risks associated with the ALFI current transfer pricing policy. And secondly, engage a legal and tax expert. Consult with a legal and tax expert to get a comprehensive understanding of the legal implication of ALFI transfer pricing practice. Seek advice on the potential changes that could align ALFI practice with the legal and ethical standard. Third, open dialogue with the stakeholders. Initiate an open and honest dialogue with the key stakeholders, including the board of directors, about the identified issues and potential risks. Present in the finding in a transparent manner, emphasizing the need of ethical business practice. Fourth, proposal for policy changes. Proposal changes of ALFI transfer pricing policies to align them with ethical standard and legal requirement. Advocated for more responsible and sustainable approach to tax planning that consider both profitability and ethical consideration. Fifth, corporate governance training. Advocated for strengthening corporate government policy to prevent aggressive tax planning and ensure adherence to ethical standard. Propose the implementation of oversizing measures to monitor and review tax practice regularly. And six, cooperation with the authorities. Consider cooperating with the relevant tax authorities and regulatory bodies to address the retrospective tax assessment and demonstrate ALFI commitment to ethical practice. Evaluate the possibility of researching an agreement with the tax authorities to ratify any discrepancies. 7. Educate and arise awareness. Conduct education program within the organization to arise awareness about the importance of ethical business practice, especially in the realm of taxation. Promote a culture of compliance with the ethical behavior among employees. And 8. Risk mitigation strategy. Develop risk mitigation strategy to address the potential legal consequence of unlawful past action. Collaborate with the legal counsels to address the best approach to manage any legal challenge that may arise. And 9. Seek external validation. Consider seeking an external audit or validation of outfit transfer pricing policy to ensure ambitious assessment of the current practice. And lastly is long-term planning. Work toward establishing a long-term plan for outfit financial policies that balance profitability with ethical consideration. Consider incorporating sustainable and responsibility finance practice into outfit corporate strategy. Next, what are the limitations that he faced? First, Michel's power as the director of finance may be constrained by the broader corporate structures and the influence of other key stakeholders. Second, residence for executive or board members who prioritize short-term financial gains over the ethical consideration. Third, potential legal constraints that limit Alfie's abilities to make the immediate change without facing the legal repercussions. In summary, Michel should take a proactive approach, presenting well-reasoned proposals for change, engaging key stakeholders, and demonstrating the long-term benefit of the ethical financial practice. While there may be limitations, ethical considerations should guide the decision-making process. That's all for my part. Thank you.
Thank you for your time and engagement from this presentation. We look forward to seeing an incredible ideas that will undoubtedly contribute in Michael's situation. Let us hear your thoughts on this crucial topic. And once again, thank you and have a nice day.